What surprised you? Is it the fact that the markets are all on the same page, so that is in this new era, in a very difficult time, that actually Jay Powell will be right down the middle and kind of speak very clearly and give one message to the markets? Or are you a little bit surprised that actually he was so positive about the economy?
I'm not surprised that he was so positive. I was a little bit surprised that the focus was a lot on what he said and not necessarily what the monetary policy report had, because if you delved through the 60-odd pages within the monetary policy report, you still found a Federal Reserve uncomfortable with the transmission mechanism from a tighter labour market, from a weaker dollar, from augmented fiscal plans from the White House, and how that transmits through to inflation. So I really like Tom's chart on stripping out some of the core real estate stuff and look at that 30-year downward trend in inflation. And the Fed allude to that fact that there is international factors, unexplained interdependencies between wages and prices that they still don't have confidence in. So I don't think we're ready to go from 3 to 4 because of those uncertainties remaining front and centre.
How did you interpret it, Gina? Is it from 3 to 4, or is it could be 4 but more likely 3?
Well, I think the Fed funds futures market is a rather skittish market, first of all, right? So it moves around a lot. We'll probably see it move around a lot over the next couple of days as well. So I try not to read too much into it. That said, I do think that this is about a market that is trying to get used to a new Fed chairman, and his way of communicating is different than Chairperson Yellen's way of communicating. His leanings are a little bit different as well. If you recall the way that Chairperson Yellen always approached things, she very much focused on the labor market, and she focused in particular, these alternative measures of labor participation, as suggesting that maybe the labor market wasn't as strong as we had hoped. His skew seems to be a little bit more toward, the labor market actually is strong, and we probably will see wage pressures going forward. So I think that was the biggest difference for the market. And you saw that play out in the S&P 500 through consumer discretionary stocks performing pretty poorly. Some of the interest rate sensitive stocks and real estate performed pretty poorly, despite the fact that we had really good housing price numbers yesterday. So I think the market is trying to digest a new reality, a new Fed chair, and maybe a new focus on inflation pressures that really hasn't been there for a while.